Hello and welcome to The Big Question on NDTV Profit. I'm Vikram Oza. Now this Grow IPO, it has been quite the buzz, hasn't it? But this isn't just about one company. It is about a moment that we're trying to capture. It's a moment when India's digital generation is trusting technology with their money like it hasn't before. From a handful of users in the year 2016 to nearly 48 million today, if you look at Grow and the kind of rise it has seen in the number of users, it is reflecting India's fintech explosion. So this fintech industry itself is expected to triple in value, and it could go over $2 trillion by the year 2030. At least that is the projection. And the reasons are quite obvious. It is powered by smartphones. It is powered by the ease of UPI payments. And yes, we have this new breed of investors who swipe before they save. But as India's fintech story is growing, also the questions are rising. Are these platforms, are they truly building wealth? Or are they building valuations? Are they democratizing investing? Or are they simply gamifying it? And what does this success, or perhaps we have to watch what Grow's IPO does. What does the IPO and the kind of traction it is getting, what does that tell us about how mature India's fintech ecosystem really is? Are we getting a sense of how profitability of fintech companies is comparing with the performance of their stocks after listing? And this is important because, you know, behind all this buzz, there needs to be a reality check. Funding for fintech firms, it has fallen more than 30%. If you look at the performance in terms of its ability to draw in funding, it has fallen more than 30% year on year. And the regulatory costs, they seem to be rising. Public markets are starting to really separate now the serious wealth builders from the ones that create a lot of noise and hype. Which is why tonight we're asking, is India witnessing a sustainable wealth revolution? Or is this a gold rush, a digital gold rush, if you please? And that's where it is. The big question tonight, India's fintech boom, is it building wealth? Or is it chasing hype? And to answer that question, let me introduce you to an excellent panel. And they're joining us tonight to unpack the real story behind the kind of growth that we are seeing in the entire fintech universe. For the VC perspective, Vijay Chopra is joining us. He's Managing Director and CEO of Enoch Ventures. Great to have you with us, Vijay Chopra. For behavioral economics at work with our investors, Dhiraj Nim is with us. He joins us as an economist and a forex strategist as well. He works at ANZ Research. Neha Singh is with us, co-founder of Tracxn. This is a company that tracks investors and the kind of startups that we've seen, how they've been doing. They watch them very closely. Beyond that, we've got market veteran Pranav Haldea, Managing Director of Prime Database Group. Great to have you with us. And advisor to fintech firm Sunil Kulkarni is also with us. Great to have you all to get perspective on this. Let me begin by asking you, Vijay Chopra. We're seeing the kind of traction that, you know, an IPO like Grow is getting. Is that a sign that we are maturing, our fintech ecosystem is maturing, or do you think we still have a long way to go to separate the wheat from the chaff?
Well, I think that, first of all, I would thank you to invite me over on this show. I think that we have just started, this started happening post-COVID, and we have seen the number of users, who are just logging into their phones and getting onto the apps like Grow or Zerodha or Dhan. But again, I think that our system is maturing. Although there are youngsters who do not understand markets as yet, but again, these people are now 2 to 3 years old in the markets already. Maybe 5 to 6 years or 7, 8 years down the line, these people would become mature investors as well. But again, talking about the entire fintech boom, I think companies like Grow have enabled millions of people to log into the mainstream economy. And this money which was going elsewhere, now it is getting invested into markets. Unfortunately, there's a lot of F&O the speculation also. But I think that a lot of money is also getting into cash stocks and mainstream economies, and companies are also getting benefited. Just to give you a perspective, Grow has clients around 1.3 crore clients, and Zerodha has about 80 lakh. They have just rushed past Zerodha. Zerodha rushed past ICICI Direct. These companies which were of the past, ICICI, the types of ICICI Direct, they primarily, seem like dinosaurs. So, but again, these companies they came and they conquered.
Yes.
I recently met the Dhan management. They have also raised a decent amount of money, about $120 billion at a valuation of 10,000 crore. They are into the same business as well. These companies are making hefty profits.
Yes.
The total profit which Grow is making is about 1,800 crores. The total income is 4,000 crores, the top line. So it is serious money they are making. So I think our markets are maturing and we have just started. I think 5-7 years down the line, we would be an absolute mature market like US.
So Dhiraj Nim, just explain this phenomenon that Vijay Chopra is pointing out, because look, he is saying that there is a flux when you talk about the newer players. The market and the kind of maturity that we are seeing among investors, that is growing. But yet, every time there is a new entrant, there seems to be this rush towards it. So behavioral economics-wise, if you understand how investors are looking at investing, at parking their saved money, or perhaps like doing it directly because it's so easy with a swipe, what is really changing when it comes to our investment strategies and how we actually push that button?
Well, I definitely concur with that opinion. Look, I think we've just started, and it's happening at a juncture when most other asset classes are failing to deliver those aspirational returns to households, and hence we've seen significant financialization of household savings to the extent that while it is a desirable outcome, but it is happening for India at a much lower level of per capita income and investor education, if you would like. And I think the key here is that this behavioral shift is here to stay. And we have to reckon with it, we have to reconcile with it, and we have to ensure that there are smart guardrails around all of these systems that not only prevent mishaps, but they also are able to check excesses when they build up and lapses before they occur. So I do believe that from a behavioral perspective, this is a change that policymakers must be learning to live with. And as a sector itself, like we talk about artificial intelligence globally and the whole lot of debate around it currently, whether it's a bubble or it's a great trend. Look, I think the fintech sector in India rests on really strong bedrock of technology. And I think in India's growth story, technology is the biggest productivity driver. So there is no question about that fintech is driving productivity growth in the economy, and it has real value to it. But of course, because there's a market element to it, because there's an investor element to it, and a new investor element to it, we will have to be careful about it.
So we have to be careful because it's growing very fast. But is it really growing as fast as we are talking about over here, Neha Singh? You track India's startup and funding ecosystem and you track it closely. Has the era of easy fintech money now ended, or are we simply seeing the shift from private capital to public markets because there is this new growth frontier that's coming up?
So there's actually two things, at play here. So one of the fact is that, if you look at it 3 years back, IPO was not like an option that a lot of the funded startups were seeing. But yes, I think post Zomato's IPO, that's a very viable option for a lot of founders, right? So you saw a lot of good companies actually getting listed from the funded universe across, in the last 2 years. And there is a good pipeline of very interesting companies coming up. So I think that is one mindset change which has happened among founders, that now getting listed is actually a very viable option for a lot of people and to continue to grow the company. So that's one thing. The second thing, which is also sort of related, is that if you look at private funding, especially on the later stage, so that has declined from the peak, right? And that is global decline. And especially if you leave out AI, the funding, there's a lot of decline in the funding from the peak that it has happened. So especially on the later stage, right? You look at the global investors like a SoftBank, Tiger Global, which used to be so active earlier. There's hardly any investments that they are currently leading right now in the later stages, right? So that is another thing that has changed. And that is why for a lot of founders at the later stage, they are actually contemplating between late stage private versus also the tapping into the public markets.
So now that these options are opening up, like Neha is pointing out, Sunil Kulkarni, you advise a lot of fintech companies. You tell us, how is the business model changing for them now that they have all these options for funding, but also on the compliance front, on KYC? There are those norms that they need to, and perhaps the guardrails that Dhiraj is pointing out, those need to have particular focus. So is that changing the business model of fintechs?
Yeah, I think thanks for inviting me. Yeah, first of all, the business model is undergoing change because in the past you have seen that the companies have been growing, but so were the losses. So now it is not just the top line that you are particularly worried about. You are also worried about the bottom line and a path to profitability. In terms of the market, I think there is, as some of the panelists have mentioned, there is significantly large market still to be untapped, and that's where I believe that two of the financial systems, which is RBI, and financial markets, which is SEBI, and then insurance. These three regulators have a great opportunity to work on a common environment, especially when you talk about KYC, unification of KYC. So nothing has changed, in fact, on KYC part. In fact, it has become easier. In the last 5 years, video KYC has really made KYC to be significantly easier for a customer to get it. And after that, now you are able to do multiple things when you are a full KYC customer. It was a very difficult paper-based KYC, but India stack, which is Aadhaar, UPI, and account aggregator, and mobile, these four pillars of fintech infrastructure have made the entire ecosystem significantly friendly and also conducive to business and easy to comply with. So I would say that things have become easier, but what has changed in the past 5 years is that now from just pure top line, the investors are funding those fintech startups who have real path to profitability or are already making, let's say, EBITDA positive from first, second, or third year onwards.
But is that getting reflected in the way these IPOs perform? Because we're talking about the maturing of the fintech ecosystem. Pranav Haldea, these IPOs, fintech IPOs, whether you talk about Paytm or a Policy Bazaar, you know, they've shown mixed outcomes. So when you talk about Grow's debut now, does it signal some kind of renewed investor confidence where it's a considered view of the path to profitability that we're hearing about? Or do you think public markets are still a little skeptical about how fintech profitability is going to pan out?
Well, hi Vikram, and thanks for having me. I think one of the things which we should avoid is generalization. In a lot of analysis, I do find that all the technology companies, even whether it's a fintech or various other sectors which are covered, are also put in the same basket. So I think one of the things which we need to do is not generalize, and the reason is very simple, because every single IPO is coming out with its own kind of valuation, which may be expensive, which may be reasonable, which may be extremely cheap. My view on valuation, of course, as you know, is it has been that even if an issue gets subscribed a single time, it shows that there was enough demand for that particular IPO at that particular price. And I always refrain from doing analysis 6 months, 1 year, 3 years later down the line, comparing the market price with the issue price and saying whether the issue was appropriately priced or not. Because in that 1 to 3, 4 year period, of course, the company has undergone various changes. They've all, and you can see that even with the IPOs which came in 2021, while some of them have given very good returns to investors, some of them haven't. So after a company gets listed, I feel that it's only on the day of listing that we can still pass a value judgment in terms of how the issue was priced. And the reason for that is very simple, because the day it gets listed is when it becomes available widely for trading for all kinds of investors. Obviously, as we know, during the time of IPO, there are various restrictions, allocations, etc., which are there. So investors may not be able to get how much they want, and also the price is kind of pre-decided. But once it becomes available for trading, you have all kinds of investors: retail, institutional, foreign, domestic, long, short. So at the end of the day of listing, I feel that there is at least some kind of sense you get in terms of how the issue priced. But beyond that, it becomes like any other listed company, any other 2,500 listed companies whose share price will go up and down on the basis of their corporate quarterly numbers, various corporate developments, etc., which take place.
No, but Pranav, you would still try and compare when you're kind of trying to understand how the fintech ecosystem, if you're talking about it maturing, how much has it been able to do that? How much do investors understand fintech and the path to profitability? How much visibility is over there is going to be judged by the way the stock performs. So when you talk about stock performance and you talk about profitability, there is a little bit of number crunching that we've done. In fact, let's bring in my colleague from our research team. He's been tracking how listed fintech companies have actually performed after their listing, and what that really tells us about profitability, about pricing, and investor sentiment in the sector. Let me ask my colleague Jasmeet, he's joining us from our research team. So profitability and performance, Jasmeet, how's the picture looking?
Well, right, yeah, if you look at the overall fintech space of the listed players, we see a mixed bag of numbers and various remarks, starting off with the market capital as well as the growth CAGR. If you look at the PB Fintech market capital stands at 84,000 crore, while the 3-year compounded growth stands at 51% for the company. On the other hand, something like Paytm has a compounded growth for 3 years at 11%. In terms of other players like Infibeam as well as MobiWik, we see the growth to be between 45 to 33% on YOY basis. Now, going ahead and understanding the overall profitability across this fintech firms to see how exactly are they making money and what's the bottom line looking like. In terms of the fintech company has reported a loss in FY23, but we see a curve of recovery where they report a gain of 353 crore in FY25. Now, in terms of Paytm, we see the losses has been decreasing. We see the contraction in terms of losses, given that losses from 1700 odd crores have reduced to 663 crore in the previous year. In terms of the other players like Infibeam, we see company has been positive from start of 2023 itself at 136, and we see the growth going ahead at 236 odd crore in FY25. Now, in terms of MobiWik, while we see a mixed trend here, given that company reported a loss of 83 odd crore in FY23, while moved into the positive trend and again reported a loss of rupees 122 crore in FY25. Let's quickly understand how did the shares react for this particular company from the of listing as well as on Y20 basis. Since listing, for Fintech, the stock is nearly up 37%, while in terms of Paytm, the stock is down 18%. And talking about this particular year, for Fintech, the stock is down 30%, but in terms of Paytm, this year sees a recovery of 28%. Now, going ahead and understanding the other aspects of Infibeam as well as MobiWik. For Infibeam, the stock has reacted the most from its performance. It's nearly up 92%. And this particular year, the stock is on 17%. In terms of MobiWik, the stock is on 47% since listing, while it's down 58% on YTD basis as well. So we see a mixed number in terms of the performance in stock areas as well as in terms of the profitability. But all in all, the companies have been moving and making a shift towards a better performance of bottom line.
Well, maybe we are taking a page out of what Pranav Haldea has just pointed out, that when you're talking about post-listing corrections, there have been those cases, Paytm, MobiQuick, others like PB Fintech, they've stabilized, but now the public market is perhaps doing a real price discovery as well. But Neha, I want to ask you this, because funding in fintechs, that seems to have gone down around 30%. I'm just wondering what VCs are looking for in fintech companies now, because that clear path to profitability is one side of the story. But why are we seeing this kind of dip, and how differently is that funding now that the public markets are open and you're seeing more players step in? But apart from that, how is funding really panning out for fintechs right now?
So actually, if you look at funding overall, it has seen a decline. And, fintech is actually one of the top 3 sectors and continues to be one of the top 3 funded sectors. But, given the decline which is there in the overall funding, fintech is also seen decline. Right now, obviously, investors are, investing in a lot of other brands, which is the India consumer story, like your D2C brands, consumers, as well as AI is obviously one top sector, which is all investors are looking at good companies in. So I would say some allocation would have changed, but I think the decline is more in line with the decline that you see overall, and especially in the later stage, right? So as we were mentioning that some of the investors which used to be really large, like if you look at just the number of unicorn rounds, at the peak in 2021, there were more than 40 companies that became new unicorns in that year. And that number currently is probably going to end up at 6. Right, so that's a huge drop from the peak that we have seen in the late stage funding, right? And thanks to that, I think which has also impacted a lot of the companies which are mature. And that's probably also one of the reasons why you see some of the very good companies, now tapping into the public markets for their, later stage rounds as well.
When you consider all of this, and Vijay Chopra, perhaps you need to weigh in, because when you're considering a fintech, if you're considering a firm, would you look at its visibility on profitability right now, or would you say scale matters more? Even if it means burnways, you are going to kind of consider scale, growth, and put a more higher premium on it before you kind of say, yes, actually it can turn in value, but given a longer stretch of time.
Well, Vikram, I think that there are a few levers you have already mentioned. The first is the ability to grow. We look at, first of all, the promoters, their ability to spearhead their organization to that level, the vision they carry. Because most of the companies do not make it to the larger levels because the promoters do not have that kind of vision or drive, or they are not capable of thinking big. So definitely numbers do matter. The scale does matter. Of course, there's the burn in the beginning. But again, companies like Grow, if you look at the total debt, they have hardly have any debt of 350 crores. Taking an example, because this is, going to be this is going to be a listing very soon. So if the promoters have that drive and vision to make the company profitable, so there, what we look at. Another classic case is Paytm. Now, when it got listed on the bourses, it was extremely, extremely overpriced. And the market actually battered it and, took it to maybe around, say, 500 odd levels from where it is now coming back. So the companies need to have that visibility of profits. Otherwise, markets are not going to spare.
Correct.
Irrespective of what kind of investors come in, or what kind of big names come in, even whether the soft banks or the BlackRocks of the world. But again, the profitability matters at the end of the day. Markets are getting mature, as we discussed in the beginning.
Yes.
So mature markets look for profitability and sustained profitability and growth.
So that's the kind of business potential that we are seeing in fintechs. But Dhiraj, when you talk about small investors today, there would be the younger ones who are just starting out. There would be the ones that have already dealt with the traditional, the legacy brokerage firms. And you're seeing an ICICI, you're seeing all the banks getting into the securities business, and they are creating those platforms for themselves as well. And yet, when you do the comparison, you do find that they are lagging behind some of the others, the newer players, like your Grow, like your Zerodha. So in terms of the choices, when you make that comparison between tier 1 and tier 2, whether it's male, female, what's the behavior that is coming through and how investors are choosing which platform they are going to use to make those investments?
Look, it's very obvious that technology has democratized this entire investment process, and I think it's really the ease of access. It's really the ease of executing a transaction that's driving this entire surge in retail participation in the equity markets more broadly, and fintech sector especially, because that remains at the intersection of how people are interacting with the equity markets as a savings destination, as a savings instrument. So I think technology, ease of access, ease of execution, ease of withdrawal. So it's broadly the question of ease that's really underpinning this entire revolution, if I may call it that. So behaviorally, of course, that presents its own opportunities and challenges. And I think a lot has been said about what the regulators need to do.
Yes.
And I think that's important to bear in mind.
But Sunil, Kulkarni, now this, when you talk about these costs, there is customer acquisition, those costs are climbing. There is compliance costs, that has to be seen as going up. So when you talk about sustainability of fintech, can Indian fintechs remain competitive without burning cash, just taking away from what Vijay Chopra has been saying and the way investor behavior is also panning out? Because you need to consider all those aspects when you talk about sustainability.
Yeah, I think it's a good question. The answer lies in, as Vijay mentioned, is the scale. Not every fintech can scale up to that level, and that's where the cash burn. There are, if you look at Global Fintech Fest, and there was practically no space to even move inside the fest. There were more than 10,000 fintechs in the country, arguably. So not all of them would survive, and therefore the scale is important, and the business model and the USP of that particular case is important. If you look at a simple case, we are not talking about even stocks. A company called stable money has created a fixed deposit marketplace. And that fixed deposit marketplace is on a smartphone. You don't need to go to branches. You do a video KYC, do a UPI debit and create a fixed deposit. And there are now many such fintechs that have come. So starting from fixed deposit to bonds, to mutual fund, to equity, there are now fintechs across entire ecosystem, and there are provisions for making them profitable, and scale is definitely one of the factors where this whole thing will pan out, that who will survive and who will continue.
Who will survive and who will continue is an important question to ask, because there are several segments within the larger umbrella of the fintech ecosystem. Neha, from all the sectors that you track within fintech, which one seems to be doing better? Is it wealth? Is it insurance? Is it neobanks? What exactly shows the maximum potential to grow, considering all the funding possibilities, the compliance issues, all of that, and what investors like using? There are certain things that you would want to do on your mobile phone, and perhaps there would be certain things that you want your traditional brokerage firms, you want that kind of intervention happen. So where do you see, which segment within the ecosystem of fintech are you seeing maximum growth?
So we are actually seeing companies come up, and just in terms of if you track the number of investments that have happened as well as the funding that has got in, all these segments are actually showing an uptick. Particular of interest is wealth tech. I would say that a lot of the investors are looking at. This is on the back because there is a lot of strong tailwinds which is there, right? As your per capita incomes are rising, disposable incomes are rising. You have sort of more disposable income for investments across different asset classes. So a lot of these companies are actually, having a very strong tailwinds. So wealth tech sector is probably one of the sub-themes where investors are looking at companies in. And the other being insurance tech. India has been a very under-penetrated market from the insurance perspective. So you saw also some of the IPOs happen in this space. So this again continues to be one area of interest which is seeing companies scale.
Yes, indeed. And now that we are seeing this kind of action in the primary markets, Grow IPO, of course, is what started off this debate. It has shown us that India's fintech story, it's no longer just about startups and scale. It's about sustainability. It's about building trust over a period of time. And that's an important piece when you're dealing with investors. But from funding winters to regulatory tightening, the industry is definitely maturing. The big question we are still chasing is, are we building lasting wealth, or are we just chasing momentum? And it seems to be, from the discussion that we've had, that yes, technology is definitely helping us build lasting wealth. And of course, the proof of the pudding is in the eating, and we'll have to wait for the numbers to kick in, for investors to kind of come away and say, yes, the costs are over here, are low, and we can still make a lot of money in the bargain at the end of any financial year. But as it turns out, either way that we look at it, this digital investing revolution seems to be here. It's reshaping how millions of Indians are thinking about money and markets and financial freedom. I want to thank my guests for bringing in their sharp insights and perspectives. Vijay Chopra, Dhiraj Nim, Neha Singh, Pranav Haldea, Sunil Kulkarni. Thank you very much all for joining us on this edition of The Big Question. And to you, our viewers as well. It's a pleasure having you with us, and indeed, we'll keep our quest on to answer the big questions here on NDTV Profit. I'm Vikram Oza from me and the team. Thank you for joining us.